Hi everyone, it is Noelle from Verivest, and today with me I have Merriman from Cetan Income Fund. Thanks for joining me.
Well, thank you. I appreciate the opportunity.
Of course. So let's just get right into it. Tell us how you got to where you are today and what your origin story is.
Well, how I got here might be a little bit of a long story. I've been around for a while. But I basically, after I graduated from college, I was born and raised here in Eugene, by the way. We're based out of Eugene. And after I graduated from college, I moved to Portland. I went to work for the largest community bank in the state at that time. Learned all about commercial banking, spent 6 years there. And of course, you know, the economy was not so great in the early 80s here because of the timber crisis. So then I moved on. And of course, in my brilliance, I went to work for Savings and Loan at the beginning of the savings and loan crisis, actually on purpose. I was a part of the executive team that took a large savings and loan, and we demutualized it. So we took it public. We had a German family invest in it, and we became a savings bank. On the day I started, we were a mutual company, and after the end of my first day, we were a savings bank. And so we changed that bank, and through mergers and acquisitions and growth, a lot of organic growth, we grew the organization, and it turned out to be a very profitable franchise up and down the West Coast. We're about $6.5 billion. And then the bank got sold, because that's what happens to banks. Holding companies need their money, or they need more capital, or something happens. And that was an interesting experience for me. So I, of course, was part of the executive leadership based in Oregon. And so I did not get offered a position with the new bank, and which was fine. So then I spent a couple of years doing mortgage lending out of my home. I had young children, and that was something to do to keep me busy. I had a dial-up fax machine. That's how long ago that was. That's how we communicated. And so then I did that for a couple of years and got pretty bored. So then I went to work for an economic development organization based out of Albany, but I covered 14 counties. I was the executive director of the largest SBA certified development company in the state. I did that for 9.5 years. All kinds of, subordinate debt funds funded by various government, state, local, federal government, either loans or grants. We ran a big microloan program that covered 14 counties. And, that was my period of the good work. I love that work. But I drove a lot, and I had really long days. And by then, my children were teenagers. And so not a good time to be on the road. And so I left there and spent a couple of years as a regional president for a credit union, which was a fine experience. But then I had known this banker for many years. And in fact, her father founded an Oregon community bank years and years ago. And so I knew him. And we met one day, and she just said, "Why don't you come help me grow this bank?" She was the CEO of a bank that was founded in, I think it was 2004, maybe 5. And so I did, just because I couldn't resist. And then I spent 9.5 years there. So I went through the Great Recession. I was the only executive on the team that had any in-depth, really credit administration experience. And so our little bank didn't have to take any TARP money. We actually grew through the recession, and we took hardly any loan losses. So I ended up being the chief credit officer as we got bigger. And I spent probably almost 3 years in that role. But then I woke up and I said to myself, I'm not sure I really like this work. I love the bank. I love the people. I love credit. That's what I do. But I really didn't like sitting in a corner writing policy or auditing files and finding things wrong. It just wasn't my cup of tea. And I always wanted to be an entrepreneur. And if you really listen to what I said, it's basically I put myself in positions like that, even though it was in a banking industry. Mm-hmm. And so I decided to leave, and I just left. I had just had a grandchild in Cleveland, Ohio, and so I traveled back there frequently in that year. And but one of my clients kept in touch with me, Stephen Yett, who's now my partner, and he was making private loans. So he would call me and say, "Oh, I'm doing this loan. What do you think about this scenario? Or what do you think about this title issue? Or what do you think about loan documents?" And so we started talking about these deals and meeting frequently. And I don't know which one of us said it, but we said, we should do this together. And so we started the fund. It was ideal for me. It brought me back to my roots and to what I love doing, which is, being engaged with the borrowers and the investors and doing all the fund management operational setup and growth. And so that's how I ended up doing what I'm doing.
Awesome. I love that. I love that story and how you kind of just moved on and on and on. That's great. What is the origin of the fund?
Well, so as I spoke, Stephen and I were talking about, we should do this together, the private lending. And at the time, I had an idea of what that meant, setting up a fund. I thought, it can't be any harder than setting up a bank, which I had done before. And so that's basically what we did. We went through the process of getting all the legal documents in place, all the systems, the underwriting. And, private lending is a little bit different than my background. A lot of lenders are collateral-based lenders, and they don't look at character and they don't really look at cash flow, but we do. And so we had underwriting systems to set up and a loan servicing system to set up. And so we got all of those organizational structures in place. And it took about 4 months. And we launched in January of 17. We made our first loan in March of 17, and we've been growing ever since.
Awesome. Love that. How do you guys source deal flow, and what is your acquisition strategy?
Our deal flow is sourced mainly through our networks. Obviously, I have a large banking network in the state of Oregon. We only do loans. We only accept loans that are on real estate that's in Oregon. And so that's our focus. I get a lot of referrals from bankers. My partner, Stephen, is also a commercial real estate broker and knows several residential real estate brokers. And so we get referrals from them. We also get referrals from title companies, attorneys, CPAs, professionals that we've worked with, either one of us, in the state. And, we're really interested in the borrower and their project and what they're doing. I learned a long time ago, it's not what you're loaning on, because that can change. It's who you loan to and what their character is. And if they know what they're doing, we spend a lot of time on project vetting and those kinds of deals or details. And then, what was the other half of your question?
Okay. Your acquisition strategy.
The strategy, I guess, would be to acquire small balance real estate loans. So our average loan amount is $350,000, and that's by design. We'll talk later. I believe you have a question about risk mitigation, but that's one of our designs to mitigate risk in the fund. It also allows us more flexibility because we can do more loans. We don't get all of our capital tied up into one asset.
Yeah, got it. That makes sense. What key markets, you mentioned you're in Oregon, but what key markets do you operate in, and why do you operate in them?
So, Oregon is an interesting state right now. We have the largest housing crisis shortfall in all of the nation, according to Freddie Mac. And I think that's been exacerbated by recent events, the wildfires, and particularly the southern part of the state. But I recognized that back in about 2014, that's where we were headed, simply because the housing starts had dried up during the recession. And then yet we were still seeing all this in-migration of population. And so you look at that and you say, where would you rather be? Southern California, where nothing's affordable. Seattle, where it's not affordable. Portland is still kind of affordable, but even then it's not. So we saw that as an opportunity. About 65% of our loans are in residential real estate, those single family 1 to 4s. And so we're focused in the western half of Oregon, which technically is western Oregon and central Oregon. So we'll go over to the Bend area up around Dallas. Occasionally we'll go outside of that market and go over into eastern Oregon, but we serve southern Oregon too. So the Klamath Falls area. Right now we have loans outstanding in 13 counties.
Okay, wow, love that. Okay, what is your investment philosophy and how do you determine whether a deal is worth doing?
Well, it has to do with that project vetting that we do. When people submit a construction budget to us, we go line by line. It cannot be I need 50,000 on the first draw and 50,000 on the second draw, which I have to tell you, in the first few months of being in this industry, that's what I get from people. And so we have to lead them down a more specific budget line item. And because my partner is a real estate developer and I've been in the business so long, I know what construction costs are. And I know how a development project works, and so does he. And so we spend a lot of time looking at what folks are doing. And, there's a reason for that. And that's because we want them to be successful. Our objective is to help them succeed. Well, we make money and they make money. If we both can't make money, I don't want their real estate. We don't have any intention of boosting fund yield through default interest or late fees. It's just not how we're designed. It's not what we're doing.
Yeah.
Does that help?
Yeah, that's awesome. What do you do to ensure you get a return on your capital, risk mitigation? Back to you. Yeah.
Well, so, given my banking background, you can imagine that was my number one focus was risk mitigation. When investors entrust us with their money, I'm going to ensure that they're going to get their capital back. So we do a number of things. We use very little leverage in the fund. We have a small line of credit that the principals guarantee. It's secured by the assets in the fund, but it's $1 million. It's just for temporary liquidity, like when we need to fund a loan, we're waiting for investments to come in or a payoff to come in. And so that mitigates liquidity risk. It ensures investors that there's very little be out of our control that could put the fund at jeopardy, where we'd have to liquidate assets at a discount that would jeopardize their, capital position, or that's setting in front of them during, risky times. And then the other thing I mentioned, the small balance, the average, balance, 40 loans out of a portfolio of 13.5 million. You can take a number of those and separate them out. It's not like you have 4 loans and if one goes down, you've got 25% delinquency. If you have 40 loans and 4 go down, you have a much lower number, and they're spread out, different risk profiles in each credit. And so, that basically ensures that the credit risk is mitigated as much as possible. And then the other significant risk in a fund is so you've got liquidity and credit risk, but there's also interest rate risk. And I know people in private debt funds may not consider that as a great risk, but they haven't been through a time like the mid 80s when inflation hit so fast and so hard and rates went through the roof that, if you held any investment for very long at the beginning and wasn't able to move out of it, you were losing. Or bond markets don't always do well during certain times. I'm not really clear what that is anymore because the markets don't always do what I think they should be doing. But nonetheless, if a certain, you want some liquidity of your investment. So we've set the fund up with very short bridge loans. Our average maturity is 12 months. And so every 12 months, we're getting funds in. And for example, when COVID-19, when we went into the shutdown and we realized what a serious matter that was, we were actually about a week earlier, 2 weeks. By the first part of March, I knew that this was a really uncertain time. And so we immediately delevered the fund. The other leverage that we do have in the fund is investor notes. So people can put in and loan the fund money versus equity. And then they have a shorter liquidity too, because those mature faster. So, we deleveraged the fund and we tapped the brakes on new loan originations, which was hard to do because we had a full pipeline. We had a banner February. But the way we operate and the way we manage the fund with those quick, decisive decisions, I mean, we froze redemptions, we did the hard things to message out to your investors. And in the end, though, within 45 days, we were sitting on 35% cash in our assets under management because the loans revolve so quickly. And so if you're an investor, that should be important to you. So your management team can react quickly and, to uncertain times. So now we're back lending, though. That only lasted about 60 days because the housing market, which is 65% of our portfolio, is very resilient. So, yeah.
Awesome. Great.
That's how with our experience, if risk is of concern to people, we definitely know how to mitigate risk. And we do it. We don't just talk about it.
Who are the key players involved that allow you to execute your acquisition strategy?
Well, obviously, my partner, Stephen Yatt, and I've spoken regarding him earlier. And he's instrumental and active in the operations. His brother is also a part of the management team, the fund management team. He's based out of New Jersey, and so he's active with us. But we have two people on staff. We brought on a loan officer, an associate, back in May of 18, and the years are blending together on me. And so he's exceptional. He didn't have any lending experience when we hired him, and I did that by design because I wanted to train him. I didn't want to inherit anybody's, habits or bad practices. And then we were very fortunate a year ago. The person who headed up the community bank where I worked, their loan operations department, joined us. She's an incredible administrator and loan servicing specialist, and now investor relations specialist. So we've got a great little group and we're having a lot of fun.
Yeah, you guys are little and mighty.
That's right.
That's awesome. Well, thank you so much, Mary. It was so nice getting to know you and learning about Cetan Income Fund, and we'll talk to you later.
Great. Thank you.